Now let's take a question here from the past papers. We are doing chapter 1, Advanced Financial Management, Replacement Decisions. We know that we replace an asset when it has the highest net present value. In this video, we want to discuss through an example and illustration how to replace or when to replace an asset using equivalent cost. We will take an example from May 2017, question 5B as it appears there, Advanced Financial Management. By the end of this illustration, I'll give you an exercise from December 2024, question 1C. You attempt that question and we will be uploading the same illustration in the YouTube within the course of the day or tomorrow. So let's take this question here. But before I take the question, you should be conversant with how to use the present value interest factor tables as provided by the examiner. And what I'm talking about is those tables there, the first table and the second table. Now, the first table and the second table, that is. Now, let me go straight away to the question. You are told Chuma Limited operates a machine which has the following maintenance costs and resale values over its 4-year life. The purchase price of the machine is 25 million. You are given maintenance costs and resale value. I've presented that information here. The maintenance costs are here. Year 1, 75. Year 2, 11. Year 3, 12.5. Year 4, 15. These are maintenance costs. Resale values by the end of the year, 15, 10, 75, 25. Then you are told the cost of capital is 10% and purchase cost is shillings 25 million. So purchase cost is the cash outflow in year 0. So find what we have done here. Replacement in year 1. What will be the equivalent cost if I replace this machine in year 1? I just have a first table here, replacement in year 1, years 0, then year 1. Cash flow for year 0 is at 25 million because the purchase cost for that machine was 25 million. So 25 million is my purchase cost. So to be a negative here, I'll call that year 0, 25 million. Discount factor at 10% is always 1. So at year 0, the discount factor is always at 1. Then present value, 1 times 25,000. This negative here, you get that. Year 1, 7,500. Note that in year 1, the resale value was 15,000 and maintenance cost was 7,500. So what are we left with? If we resold this machine, we received 15,000 and maintenance cost was 7,500. So what are we left with? If you receive 15,000, you spent 7,500 for maintenance cost, you are left with 7,500. So that is the cash inflow for year 1. Present value or discount factor, you just take 10% year 1. You read this number from the table, 0.9091. Multiplied by 7,500, you get 6818.25. You sum these numbers, the present values, you get 18,181.75. That's the present value. But what is my equivalent cost? So what I do is that I will take the present value, the summation of these two numbers. Remember, this is a negative, this is a plus. 18,181.75 divided by present value interest factor for year 1, which is 0.9091. So if I divide this by that, remember this is the present value. This is the present value. The denominator is present value interest factor. I get 19.199. That is my equivalent cost. So if I replace my machine in year 1, the equivalent cost will be 19,999, a negative figure. So this summary here is very important because it helps me to know when or in which year to replace the machine. We say that you replace the machine when it has the highest net present value. Because if you wait for this machine to start reducing the net present value, obviously, the wealth of the company will be reducing. So always replace the machine when it has the highest net present value. The same applies here when you are using equivalent cost. Replace the machine when it has the highest equivalent cost. So this table will help us to answer our question according to what the examiner was looking for. So year one, you put the equivalent cost there. We go to year two, you take year zero, year one, year two. These cash flows for year zero, they are the same here. 25,000 was the initial capital outlay, man out. Year one, we have it from here. We only need year two. Year two, what happened? Year two, the resale value is 10,000 and we incurred maintenance cost of 11,000. So what am I left with? If I resold this machine at 10,000 and I spent 11,000 for maintenance, I'm left with 1,000, which is a negative. So this will be negative for year two, negative 1,000. Read from the table, this and this is the same from above here. So just read 10% and year two, you get 0.8264. Multiply this by that, you get negative 8264. 826.4 negative. Summation of this gives you 19008.15. That is your present value. Then you can calculate your equivalent cost, that is present value, over the present value interest factor. That is summation of this now. You'll be summing this now. Don't sum one. For year one and year two, you get 1.7355. So present value over net present value interest factor, summation of these two, you get negative 10.953, this one here. So we have taken, to get this equivalent cost, we have taken present value for year 0, year 1, year 2, divided by summation of these two. Then we get negative 10.5, negative 10,953. We go to year what? Year 3. We go to year 3, we just have years 0, 1, 2, 3. 1, 2, 3, you do the same. Cash flows, negative 25,000. Year 1, 7,500. Year 3, we have it here. Year 2, we have it, so we just need year 3. Year 3, we resold this machine for 7,500. We spent for maintenance cost 12,500. So 7,500 minus 12,500, you are left with 5. Is it making sense? Is it 5,000? I think so. 5,000 negative. Then you read from the table 10% at the free 0.7513 multiplied by negative 5,000. You get negative that 757. Add them together, total present value, you get negative 22,765 divided by, you sum up those three from year 1, year 2, year 3, and you get something like 2.4869. So equivalent cost, you divide this present value by 2.4869. You get negative 9153, this one here. So that is my equivalent cost. Lastly, so if I replace this machine in year 3, that will be the equivalent cost. Lastly, year 4. If I replace the machine in year 4, what will be the equivalent cost? I do the same. So I have all this information. I just need for year 4. These ones that we have this one, we have this one, this one, this one. So for year 4, resale value is 2,500. I incur cost of 15,000. So what am I left with? 12,500 negative. That is 2,500 minus 15,000. I'm left with 12,500. That's my cash flow. Go to the table. Present value interest factor. You read 10% and 4. You get 0.6830. Multiply negative 12,500 by 0.6830, you get negative 85 at 7.5. Sum up all this to get present value, and you get 31,302. Then present value interest factor, which is the denominator to divide with, you sum up those ones so that you will get negative 31,302. This present value here, I'll divide it by, if you sum up these discount factors here, you get 3.1699. So the equivalent cost now will be, if you divide this by that, you get negative 9875, which is there. So once you have calculated the equivalent costs, the next thing is to answer the question, because the question was advise the management of Chuma Limited on how frequently the machine should be replaced. So I'll just look at my equivalent costs here, and then I identify that year when I have the highest equivalent cost. And obviously, I can see it is year 3, because year 3 is negative 9153. Is the highest. Remember, these are negatives, so you consider that. So replace the machine in year 3. In year 3, when it has the highest equivalent cost. So that was the answer for that. Now, before I leave, remember to take exercise December 2024, question number 1C. Question number 1C. December 2024, number 1C. Number 1C, which is there. Maybe you can take it. Number 1C. Is it legible? If it is legible, number 1C is similar to what we have done. Replacement of a machine using equivalent cost. So that is the end of that. If you need help, the number is here, plus 254 727 8710 93. 0727 8710 93. So that is our revision for today for advanced financial management. Replacement decisions, specifically replacing an asset using equivalent cost. So we meet next lesson as we take the December 2024 question 1C. So we meet again.